In this video, traders, we're going to look at why do prices move quickly during the open and close. Stay tuned. Hey guys, hey all, and welcome to you. Alright, so this is a question that came in. Why do prices move more quickly during the open and close? Great observation. Someone's been trading for a couple of months and they've said, listen, I've noticed that the open prices started to move a little bit more and they do the rest of the day and the close as well. So great observation. Good that you're watching the market, you're looking at the market and you're actually seeing and observing and taking notes and then querying what you're seeing. So this is a common thing that happens regularly, and okay, not every day, some days not the same, but generally speaking this is common because, and this is the reason why, you have the cash market opens at a specific hour and it closes at a specific hour. So you can only trade stocks during that hour. Yes, there are some after hours and pre-market, but for most times when you want to trade options, you want to trade all the other bits that all link together, the markets are open between those hours, specifically if we're talking about the stock markets. And so what happens is you get a lot of orders that are going to trade at the open that are built up overnight. And so a lot of people say, okay, I'm going to buy that at the open. They might even put an order in with their broker. They might decide to do it personally. They might decide to do it for the fund. Whatever it is, there's decision-making process been going on since the market is closed when the market is open. And of course, then when the market opens and the bell rings and people can suddenly start trading in volume, in size, and start doing other things as well that are related, that increased order flow causes more volatile movements in price potentially and quicker changes in price, because you've got a lot of people all of a sudden who are all trying to trade, and often we'll get drives in one direction or the other because there's a supply and demand imbalance. Say a lot of people are buying at the open, a lot of people are selling at the open, and you might get one with the other, or you kind of get these whipsaws where a lot of people buy, a lot of people sell, and it kind of swings back and forth. And that's just because people are doing orders. Now that's different to a gap, and a gap is basically a new price that's kind of derived in, if it's a stock, where people believe the open is going to be. It's some kind of the best auction process for where the stock's going to open. Futures may have moved overnight. Again, similar type of thing. There's an auction process and then it opens. So that's slightly different, but you're talking about the actual movement in the first kind of 20-30 minutes of a day. It is because there's a lot of institutional and other orders that are coming in and are moving that price back and forward. There might not be liquidity as well to soak it up, whereas as we start to go through the day a little bit further, a lot more people have resting orders, limit orders that haven't been filled perhaps earlier in the day. They've got resting orders and limits they want to work throughout the day. Might come and say, I want to buy 85, someone else 70, someone else so and so. They stack all the orders in. It starts to fill the order book up with liquidity. And then if the order flow as well is lower, the execution flow, the trade number is lower, then it starts to be a lot kind of smoother and not as wild. And then if that dies right down, like at lunchtime, we get what's called choppy markets where they might move up and down a little bit, won't go too far, just because there's plenty of time for people to do orders. There's no rush. There's that rush at the open because of all those pent up orders that have come from the prior day that was the overnight session. The close, very, very similar. The close is, hey, I've only got an hour or 30 minutes left to do this order. I need to get it done. Multiply that by however many participants there are, and then we get the same kind of rush that we do at the open. Now, the close depends on what's been happening in the day as well. If it's been super, super volatile in the day, you might get a lot of people who have been trading in the day want to come out of their positions, and that causes a bit of a spike. If it's a normal day, you might find people say, oh, well, I've got 90% of my order done. I need to kind of be urgent and get the last 10% done because I want to get this order done today. And they've been separating out throughout the day. So you might find a bit of a pickup in order flow then. Some of the algos will do the same automatically as well. They'll start to pick up the order flow as they come into the close. And so you've got that sense of urgency. It's like, okay, when the bell goes, I can't execute anymore. And so I need to get my orders done. I need to start lifting offers. I need to start hitting bids. I need to start becoming a bit more aggressive than I was perhaps 2 or 3 hours ago. And that causes a bit more of a rush, a bit more supply and demand imbalance, a bit more of a two-way flow and two-way trade right up until the closing bell. So good observation. Open is a lot more volatile. Closes can be a lot more volatile. Generally, the open is more than the close, but it does depend on the conditions, current conditions of the day, current conditions of the quarter as well. If you're in a kind of brutal bear market, often the close is just people dumping stock across the board and you get a real flush. If it's very quiet, then the close might just sit around the VWAP and not do a lot. But the open often will be more aggressive than not, if you like. Although not always. Obviously, there's some days when it doesn't do anything. But great observation and a great time to trade if you can spot an opportunity and you've got a strategy that specifically works around those times. All right, guys, take care. See you next one. Bye-bye.